Thank you guys for joining me back on my channel. Thank you for being part of this new series where we're discovering and we're talking more about personal finance. Today we have Matt, the mortgage guy, the one and only. How are you?
I'm doing well. I'm doing well. Thanks for having me on, Josh. I'm excited to talk about what I do best. Consult first-time home buyers, talk to people about, boiling mortgage down into simple terms, I think is probably my claim to fame and what is, I found the most success with.
So you're famous now.
Yeah.
So tell me a little bit more about what do you do, what your company does, so people can have a little bit more information.
Sure. So I'm an independent mortgage broker based in California. Even though I've been talking and consulting with people nationwide through the YouTube channel and people that connect through me there, I'm only licensed in California. So I really just work with people out in California. And as an independent mortgage broker, what I can do is I can look at 50 or 60 different wholesale lenders to find the best option for somebody. But even more important than that, I think it's, really guiding somebody through the home purchase process, which for most, it's the biggest financial transaction of your whole life. And so it's big and it's scary and it's complicated. When I first got started, and I've got to give my wife credit for this, she gave me probably the best advice I've ever got in mortgage when I was using terms that I learned in college as a finance person, getting a finance degree, fancy stuff, talking about yield spread and using fancy mortgage terms. My wife kind of shook me and said, listen, talk to people like you're talking to my grandma and explain to them in simple terms what you're saying, because I know you understand it well enough to explain it in simple terms. And so that's really my number one role, I think, is just simplifying mortgage for people so that they understand it to the point that they're comfortable with the process. Because, I've learned and come to terms with the fact that people don't like getting a mortgage. It's not fun. But they love real estate and they love home ownership and all the things that come through, getting a mortgage, which most people have to do when they buy a house. And so, making it relatively simple, making it relatively stress-free. That's the number one goal of me and my team. And I've got a great team that I've surrounded myself with where we're all aligned with trying to serve people at a high level and trying to give them a really good experience, which includes keeping it simple.
So, and you mentioned you're an independent contractor and broker, right?
Correct. Yeah.
So how does that changes from the big companies? What makes it different?
Well, the biggest difference is, if you look at it like an insurance person who's quote unquote captive, if they work for Farmers Insurance, you come to them and say, I'm looking for an insurance policy on my car or my house. They're generally going to have to give you a policy that's written by Farmers, versus a broker can say, oh, Mercury's got that, Farmers has that, State Farm has that.
Right.
And so the reason I left direct lending where I was at and came to the broker world is because I felt like I could better serve the clients, because Josh with a 740 credit score and 10% down probably needs a different loan product than somebody else with a 596 and 3.5% down. Mm-hmm. So in order to best serve folks, I've got to have an array of products and say, you know what, based on your scenario, here's where I can get you the best loan terms. And so that's what it is. As a broker, I'm able to broker to different lenders based on your needs and your goals.
Yeah, totally. I don't think people realize the importance of a down payment or a good credit score. It happens all the time. Like, I'll talk to people and they believe they'll get a 2.75 mortgage with a 620 credit score, which it's a hard thing to get. Like, you need a great credit score in order to get a better deal. So talk to me a little bit about the importance of a good credit score.
Yeah, I mean, it's super important. And on this topic, I think that me and you probably align in this way, where if somebody's not financially prepared, mm-hmm. it's in their best interest to wait. And the example, like you said, somebody's gung-ho and they've got a 620, but they can barely scrape enough for a down payment, and they are thinking they're going to get a 2.75% rate. Lenders price their loans based on risk. And you can be the nicest person in the world. And I've met a lot of nice people that have credit challenges. You know, me, myself, and plenty of people I know, when you're walking through a college campus and people are handing you credit cards and you have no idea how to handle debt and credit, that can lead to, you know, a diminished credit score. But it's hugely important because the lenders, basing the terms based on risk, say, hey, in the past you haven't been super responsible, so in order to, you know, compensate for that risk, we're going to charge you a 3.875. You know, the next guy with a little bit better credit might get a 3.25. Somebody with 760 credit who's putting 20% down, super low risk. Let's give them a 30-year at 2.7%. And so that's, it's really important. And it's not just for mortgage, right? It's for everything. The car loan you're going to get is based on your credit score, the mortgage loan you're going to get. And so I like what you're doing. And I like what a lot of people in the financial space are doing on YouTube, because you really think about it, there's next to no financial education in schools, which is, it blows your mind when you really think about it.
Yeah. Hence how I have so much student loan debt.
Right. Yeah. I graduated from school in 2005, and I am ashamed to admit I still have student loan debt.
Oh no, well, that's another conversation. Next video we'll talk about it.
I'll have you consult me.
So going back, let's say someone wants to buy a house. This couple just got married. This is like a normal situation that I see every week, right? Just got married, don't have the best income, but they want this American dream, right? They want this new house. What do they need? They come to you, and Matt, what are you going to tell them?
I'm going to tell them that no matter where they're at in the process, me and my team are happy to take them through the pre-approval process. And really, a lot of folks take that as, oh, you want this information from me, you're trying to put me in a sales funnel. And for the brokers like myself that are super busy, I am not desperate for my next deal. I can promise you that. I've got 638 people that are pre-approved, and I'm not pounding the phones every day telling them they need to buy. But by going through that process, you know, I can go a couple layers deeper than you just telling me, hey, I make $3,600 a month. I think my credit score is around this. I can really dig in there and say, here's exactly where you're at today. Here's what it would look like if you put 3.5% down FHA. Here's what 5% down conventional looks like. It's probably best that you go with this one if you buy something today. If you improved your credit and decided to work on that for 6 or 9 months and then got your credit to here, here's what a loan might look like. And, you know, presenting them options and educating them is the most important part of all of it, I think. And you probably wouldn't be surprised, but I could tell you story after story after story where people fly through the process, pay little attention to any of it, and then sign on the dotted line. It's a 30-year commitment when they're buying a house. And, you know, the terms are great in 2020, but still it's just a good idea for the average consumer to really put a little bit of thought and planning and research into it, since it is, for a majority of people, their biggest financial decision they've made up to this point in their life. So I think that's, you know, a long-winded way of saying, when that new couple comes to me, I say, let's do the pre-approval, not for me, not so I have another pre-approval in my queue, but for you, so that I can give you really specific advice based on your scenario. And you can kind of look at, because then somebody's got a scenario that's specific to them, exactly what their monthly payment's going to be, what their cash to close is going to be, what this loan versus that loan looks like. And so now they're able to take that, go back home, talk as a couple. What are our goals? What are we really comfortable with as a monthly payment? Do we want to do this now? Do we want to do it, you know, 6 months from now, a year from now? And just good conversations come of that, I think.
Yeah, no, totally. Especially for me, because I'm in the field, I do not handle anyone without at least a pre-qualification letter. I need to know where you're at financially. And you mentioned about pre-qualifications and pre-approvals. Can you talk about what the difference is and what do you suggest?
Well, the difference between pre-qualification and pre-approval is we've got all your loan documents, we've got your application, we've pulled credit, we've got a verification of employment that breaks down your pay, and we've got, automated approval. We know we can get a loan done for you. And that's what everybody should have. And that's honestly what they should want. If you're a buyer and you want to provide a few documents, have one phone call, and have Quicken Loans fire out a pre-approval letter to you so that you can go view houses, but then pay for an appraisal, pay for inspections, get 3 weeks in, and they can't do a loan for you. That's a terrible position to be in as a consumer. So don't do that to yourself if you're a consumer. And so the pre-qualification is something like that. It's something like, oh, you've got a 730 score, you make $4,200 a month. Maybe they pull credit, maybe they don't. And really, I don't know how it is in Puerto Rico, but in California, you're not allowed to go show a client a house unless you've got a pre-approval letter. And it's been one of the good changes of 2020 is that, for the client's sake, it's not something, something that's been put in place to kind of, put down an iron fist and you've got to get a pre-approval letter. It's in the client's best interest. It's for their benefit.
Yeah, I think people are afraid of what they don't know. Yeah. And usually the question that I'll get follow up with that is that I don't want them to like ruin my credit score. I'm sure you hear this often too. And I don't want them to pull my credit score. I've had people that are like, I don't want to tell you how much money I have saved up. And I'm like, well, good luck, because I need to know like if you're actually financially prepared for this. Like, I'm not gonna go through the whole process, and then when you realize that you need $10,000 to close on this deal, you'll only have 3,000.
Right. Yeah, and that's something too. Most people, I think, when you have the conversation with them and you explain to them it's for their benefit, they start to understand, because they don't want to go look at a bunch of houses that they can't write offers on because they can't close on a loan. They don't qualify, or they don't have enough down payment. And so, it's not just the realtor or the lender protecting their time because this person doesn't qualify. It's protecting the consumer and saying, hey, get all your ducks in a row. And I tell people too, a common question is, should I do it on Wednesday if I'm looking at houses on Sunday? Should I do it in December if I'm planning on looking in January? In my opinion, the sooner the better. You just get a full picture of what exactly you can qualify for. There might be something uncovered in your credit report that you didn't know about, or you hadn't resolved, and it affects your credit score by 50 points. If you see that in November, get it resolved, and then you're shopping in February and your credit score is 40 points better, it might be a quarter better in rate. You might save $50 a month and $22,000 over the life of the loan. That's not going to happen if you're only going to get pre-approved 2 days before you want to go with Josh and look at houses, which another common thing is just, no, not yet. Okay, I see a house I like now. Yeah. And by then it's just like, what do I need again? It's this big rush, and it's just not the same experience for the consumer.
No, it's going to be too late, especially now. And we can talk about the market right now, because there's no time to waste.
Right.
I tell people, you need to walk out of this house with an offer in mind, and we gotta put it in right now because we might lose it.
Right. Yeah. I mean, it doesn't look like it's getting any better. There's such low supply, such huge demand. Some numbers I saw for California was, you've got building starts and you can kind of see what future inventory is going to be there on how much is being built. It's 16% behind demand. So it's only getting worse. It's not getting any better. So 2021 will be interesting. It'll be interesting to see what happens, because like you said, you've got to write fast, you got to write furious, you got to write high, you got to remove appraisal contingencies. It's wild.
Yeah, no, absolutely. I agree. And talking about that as well, what are your thoughts on the market crash? When is this happening, Matt? Because that's my that's my next question. People are always like, Josh, should I buy now? Should I not buy now? Like, what's gonna happen? And I always tell people, I'll tell you my opinion. I don't know if there's a market crash. Maybe there is going to be one, but if the numbers make sense for you now, they should make sense for you after, or whenever that happens.
Right. Yeah. And that's the thing too, is I remind people that, you know, whether it's stocks or whether it's real estate, you know, timing the market is just a bad idea. And I give the example of the house I bought in 2006. If you would have told me, no, don't buy, wait, and come talk to me in 2010, 2011, well, gosh, I bought it for 345. Now it, you know, I could buy it for 200. I would have been upset. That same house I still own. I've got renters in it that are paying the mortgage off every month. You know, we're 14 years into a 30-year mortgage. So it's paid down significantly. It's probably worth 25% more than what I bought it for. So it hasn't appreciated a ton because it dropped before it came back up. But long-term, real estate's always a winner. Yeah. And I'm going to be on a podcast tomorrow with Michael Zuber, who's another California real estate investor. He does one rental at a time. He's predicting 10% price appreciation in 2021. Really? So for the people that are on the sidelines waiting for a crash, you know, if his, you know, theory holds true, or if his predictions come true, they're going to be in a lot of pain seeing prices go up by another 10%. But, you know, the thing to consider is a lot of people are like, oh, you know, after the end of the year, these people that are in forbearance are going to get foreclosed on and prices are going to drop 30%. Like, that's such a ridiculous statement on so many levels, because it never happens that fast in housing. If forbearance has a big impact and people, you know, who are out of work don't get back to work, and we have some foreclosure wave, that's going to affect prices in 2022 and 2023, because it's going to take a while for that cycle to kind of play itself out. But I honestly, the latest forbearance numbers showed a crazy amount of people that took it but didn't need it, or took it and were still paying. Mm-hmm. And I'm talking to those people every day. Hey, Matt, I'll be honest with you. I just took forbearance because I could. Because I called my servicer and they, I asked them what I need to provide, and it was nothing. Just tell them. And so people that are still working full time, still making good money, some of them I don't blame, because it's like they didn't know what was going to happen. So they took it as kind of a, hey, let's wait and see. And so if 3 million people are in forbearance, 1.5 million don't need it. Of the other 1.5 million, half of them get back to work, back on their feet, and it's on the back of their loan, and they're going to pay it off when they refinance or sell down the road. You know, then we start chopping down, and 500,000 foreclosures or something, maybe. And I can tell you, based on how much demand there is, 500,000 homes being spread out across the U.S. Will barely dent the supply problem we have. So, you know, thinking about that, it's going to take something else to drive home prices up. Rates, we've seen, you know, the Fed can manipulate and keep rates low. That's likely to happen in 2021, and rates aren't going anywhere. I think the video I made was them staying the same, maybe trickling down even more. Yeah. And so, you know, all the crash stuff, it's great for clickbait. I just don't see it happening. Maybe it does. Maybe I'm wrong. I mean,
that's what I say. I'm like, maybe, I mean, we don't really know. I can't tell you when to buy the house. I can tell you that you should take advantage of the things that are happening right now. Right. But I think ultimately it's going to depend on the client, you know, and how secure they are on this decision.
Right. And I think it's a good idea. I've heard some folks that I like and trust and that are really trying to put out good information. You know, that guy out of Arizona, that real estate agent, what's his name?
I don't know. He has glasses.
Yeah.
I know.
Really good content. Yeah. And, you know, he's advising people, which I think is good. You know, you got to be really financially stable to buy right now. And I agree with that. When somebody comes to me and they barely qualify, they can barely put together 3.5%, maybe you don't buy right now. You know, but if you've got tons of assets in the bank, you know, you're going to buy a house that you can easily afford. And, you know, those buyers are going to be fine. You're getting yourself a 2.7 30-year fixed. You're going to keep this home for over 10 years.
Yeah.
Buy away.
See, I think you should never buy a house if you're not financially stable. People want to like maneuver. Maybe if I do $100 here, $200 there, I can make it happen. If you're looking at a house as your personal house versus you're looking at a house as an investment, which are two different things, the numbers have to make sense for you. And I find that people want to involve both at the same time, and they want to pay as little as possible and make it happen. And the point that you made was very smart, because financially, either you're ready now or what you should be ready in the next 5 years or so. Like, you should wait for the moment that you are ready for it.
Right, right. And that's why too, I think, you know, talking through it with you, I kind of, you know, thought in my head that it's not about timing the market. It's about timing your personal, you know, ability to buy your own financial situation. When you're ready and you've got what you deem to be, you know, some financial footing, you know, some money in the bank, a little bit for a down payment, you know, you've got a stable job where, you know, your mortgage is going to be 20% of your pay or whatever that is for the individual, that's when it's the right time to buy. And, you know, the type of loans that are being written, 30-year fixed under 3%, like that's a really great mortgage to be in. So I think that when you're buying for the long term, knowing that you're in that type of mortgage, you're going to be in good shape. I mean, that's where people who predict a huge market crash and want to compare 2008 to 2020, it's kind of ludicrous, because the biggest catalyst of the crash was all the super risky variable rate mortgages that just don't exist today. You're not going to have somebody who's sitting in a house with a $1,300 payment have a $2,800 payment in 6 months. They're signing up for the mortgage today that they're going to pay next year and the year after and the year after that.
Yeah. I did want to talk about the FHA loan. At least for me, that's the most used loan that I see more often. And a lot of people are always coming to me, oh, I can't afford a 20% down payment. However, with an FHA loan, things in terms are a little bit different. So I wanted to dive in a little bit on that.
Sure. Yeah. FHA is a great loan, and it's one that's used by quite a few first-time buyers for two main reasons. One, that they're a lot more flexible with credit and debt to income ratio. So if your credit's not perfect, if you don't make a ton of money, FHA is going to be the most flexible with getting you approved. And then by putting 3.5% down, you don't have to have a humongous amount of cash reserves to put down. And there's plenty of people that, it's gift funds, they can borrow from their 401k, whatever it is, to put that 3.5% down plus the closing costs on FHA. It's a great option. Those rates are sub 3% on a 30-year fixed as well. So it's a really good loan. Where I'm at, I'm probably 70 or 75, 25 conventional versus FHA. And really, conventional, you can do 3% or 5% down. You've got to be a first-time buyer if you do 3%. The main difference is the credit criteria, where if you've got better credit, conventional is probably a better loan for you. If you're sub 700, sub 680, then FHA is probably going to be a better looking loan. But, whenever you sit down with a mortgage advisor who knows what they're talking about, they're just going to present you both options side by side. And more often than not, one's going to jump out and it's $150 a month less.
What criteria should I be looking at when I'm talking to someone?
Well, I think that nowadays it's really easy to kind of vet any kind of business you're going to do business with. Just like, if you're going to go out for sushi, you probably look and read the first 6 reviews on Yelp. With mortgage advisors, if they're doing any level of business, they're going to have some sort of visibility online. And that's where I warn people against a big box Quicken Loans or something, because if you talk to somebody from Quicken Loans and look up their license number and they were, you know, serving tables or whatever, no knock on working in a restaurant and any of that stuff, but those aren't necessarily high level mortgage advisors with a bunch of experience and trying to build a business and repeat business. But the independent brokers and even the retail lenders are going to have, you know, tons of online reviews, tons of things online that just let you know that they do a lot of business. And I mean, I would even venture to say if somebody does a lot of business, they're more than likely good, because you're not getting a bunch of repeat business and good reviews and all that stuff if you're not doing a good job. People will definitely let the internet know if they're.
Oh, for sure. And especially in our business, referrals are key.
Yeah, and that's something too that if you know, I would imagine a lot of people are getting referrals from their network, you know, and I tell clients whenever I get positive feedback, thank you so much, Matt, you and your team made it so easy. Let me know who else I can help, because inevitably there's somebody else in your network that, you know, they might not know, and they might just be looking online. Quicken pays the most in ads, so they're showing up at the top, but that kid in the call center doesn't know his elbow from another body part, and you know, is telling you, and I see it too. And you know, it's probably advisable in most cases, like talk to a few different ones. You know, maybe you talk to the guy at Quicken and you have them send you an estimate on what a refinance might look like. And then you talk to an independent broker and, you know, we compare it apples to apples. I've made plenty of stuff, YouTube video wise, where I'm like, here's how you compare loans apples to apples. It never hurts to compare. On a purchase, I think it's even more important to work with somebody who's going to spend the time to educate you, because like we talked about, that whole process, you as a realtor, you want a buyer that is walking through that front door. They've already been pre-approved. They already know at 380, 390, 400 exactly what the payment is, exactly what they're going to put down. So they're comfortable and they're confident. When they walk out, they say, hey, Josh, what do I have to offer on this house? I really like it. My wife's in love with it. I got to have it. I already know what my payment's going to look like at these different price points. Tell me what you would advise me to offer. And you say, to get it, it's going to take $395. Okay. They already know what that, you know, mortgage looks like. And, you know, I encourage people a lot. And that's been something I've kind of been leaning into, is when somebody gets pre-approved, it's not just, you're good up to 400,000, happy house hunting, good luck. You know, it's, let's really dig in, take this back to your significant other, talk it through, ask us what questions you have, and be, you know, prepared and educated. So when you're out there looking at houses, it's not an emotional thing. Cause I'm sure you get that too. People, oh my gosh, this kitchen, you know, and they get googly eyed.
So going back, you have a YouTube channel now. Tell me about it. What was the inspiration for it, and how can people contact you?
Sure. If you go to Google and search for Matt the Mortgage Guy, one disclaimer, there is a guy named Matt Garland who's out of Atlanta, and he's MG the Mortgage Guy. Okay. Great guy. Puts out great videos, but a different guy. And I connected with him recently because I got a lot of referrals that were supposed to be his. And I said, no, here's the guy you want. And I've got my team now directing traffic and sending them back there. But if you find Matt the Mortgage Guy, not MG the Mortgage Guy, and I think I'm close to 300 videos now. Most of them are educational. It started off as just, I'm going to do as much as I can to educate people. Because like you said, people think you have to put 20% down. People have all this information or, you know, all these myths. And I wanted to get that information out there on scale. I was talking to people every day. Oh, I didn't realize that. That's cool. Oh, I could put down 3% conventional loan. Oh, thanks for letting me know. That's really cool to see. And so, you know, starting when I started back in mortgage, I was probably putting out videos within the first year. And was doing a Mortgage Monday, just committed to myself, I'm going to do one every week. It was cool too, because when I learned something new about a certain guideline, or I had a scenario I hadn't seen yet, or I had a question that was relatively common, I'd make a video on it, and it would allow me to kind of narrow in and study it and focus on it. So it kind of ingrained it in me. Little things would come up, on doing a 2 to 4 unit with an FHA loan, or things like that. And so it was educational. It was part of my, mortgage learning process as I was getting started in mortgage. And now I'm pushing out a lot. I'm trying to do 3 videos a week, and it's going to be a mixture of.
You're doing better than I am.
I'm just one take, no edits, just get it edited, put it out there. But I've started to get a little wider, because I want to talk about real estate investing. I want to talk a little bit finance, because it all intertwines.
Yes.
And I have a lot of those conversations with clients where, based on my own experience investing in real estate, based on the dozens of clients I have that have, hundreds of investment properties,
right.
I've seen a lot of stuff. And so I've learned a lot of stuff, and passing that on to folks, it's fun. I mean, that's, if nothing else, I do YouTube because it's fun.
Yeah, that's awesome, man. And I'll link down below all your information so people can find you as well. And hopefully it works out. If you are listening or watching and you're in the Sacramento, California area, Matt's a guy. Not Matt MTG, right? This other Matt.
Right. That guy's good too. If you're on the East Coast, you're in Atlanta, call MG the Mortgage Guy. But Matt the Mortgage Guy, you should be able to find me on YouTube, and I'm happy to help. I've started to direct people to just send me an email, matt@mattthemortgageguy.com, if they've got a question from out of state, because as we approach 300,000 views or so, the amount of inquiries I'm getting has increased. But I'm still doing my best, man. Reply to every single person I can, and give all the good advice that I can.
That's awesome. And thank you, Matt. Thank you. I appreciate your time and being able to chat with me. Thank you so much, you guys, for joining in. And if you want to follow up, please like and subscribe as well. Go ahead and like and subscribe on Matt's channel. Matt, again, thank you so much for joining. And I'll see you guys in the next one.